understood in the whole reversion to the mean trade that went on, and again, the 15-16 period. From a debt financing perspective, it just comes down to returns for the limited partners. I've never felt that to achieve kind of an 8 to 12% IRR from a cash-on-cash debt investment, that a private equity fund is really rigged towards that. The day rates within these past 10 years for maritime companies have not been conducive to returning that type of interest expense.
Evan?
Yeah, that's interesting. Working for a bank, not for a ship owner, but thinking about it from the ship owner point of view, all these hundreds of billions that left the market, if some of the owners have a choice and they get that nice luxury choice of equity or debt or how am I going to do it, yeah, there's not so many of you out there. So
you think it's driven, the choice is sort of driven by their circumstances? You
take what you can get in terms of financing, and if you're lucky enough that, as Evan mentioned, the projects, the break-evens are so attractive, and you can find this private equity short-term, and it can fund your project, fantastic, good for you. If you have access to the cheaper senior debt, also good for you. Yeah, so with all those banks we all talked about leaving the market, there is financing available. It's the choices that owners have that's reduced.
Okay. Michael or Jack, do you want to add anything to that? Or?
No.
Fair enough.
Yeah, I think maybe compare the senior loan and leasing and private equity. I think the different financial parameters is from a different perspective. So I think maybe leasing can cover all of these different layers of finance. So we can provide maybe very high leverage for the projects. So that means maybe we together with the banks, traditional banks, and also the private equities, and contribute very high leverage finance to the ship owners. So that's kind of sometimes we think the return is not so bad, because for many of Chinese leasing houses do shipping finance and aviation finance at the same time. But when we compare the return of shipping finance to the aviation finance, you can see the margin return is much higher, and it's less competitive with aviation finance. So it's difficult to say for shipping finance, the private equities cannot get a high return, or is too risky, or for other investors.
All right, thank you.
Can I?
Yes, go ahead.
Well, what I really wanted, the reason I didn't want to answer that question, I think there's something, that's in the past, if you like, and there are some good private equity investors who know what they're doing, but that's not going to move the needle in terms of refinancing the total re-engineering of the global fleet, and that is what's facing people. I think that's what people need to understand, that the whole of the world fleet is going to change. Decisions are going to be made in the next 3 to 5 years amongst other bodies like the IMO, but also the shipbuilders, the oil companies. The total re-engineering of the means of global trade is going to challenge, as well as be an opportunity for financial markets. So the historical model of senior lending by banks, I think, will still be part of that. But actually, we're talking about something much bigger than any of us have seen before, and in a much shorter time period. And you've heard touched on earlier this morning, but it really is going to change the way in which this industry is financed. And that will be a combination of different sources of finance. But the problem is there is a huge risk, if you like, because we're going to change the technology. The role of different sectors in the industry in making that happen is also probably going to help underpin that. One of the big opportunities for the energy industry is to enable its transition to be seen in the context of financing the shipping industry. So I think there's going to be huge changes taking place in the next few years, and that there will be business to be done as we prepare for that. But actually, the future of shipping finance is going to look very different, probably, to what it's looked like in the last 30 years.
Well, I'm going to skip on ahead then, following up on that note. I promise to come back to capital requirements for banks. But this seems like a good segue to the Poseidon principles to me, because I think you're suggesting that banks are going to have to react to these changes in technology and regulations as to how ships operate. And it seems appropriate to turn to those principles. And I know that Citi, DNB, and others were leaders in putting that together.
Well, maybe if I just sort of make a few comments on that, and then obviously Evan can add. The Poseidon Principles came out of work initiated by the Global Maritime Forum and its work on decarbonisation, and it involved many parties, not just banks. Originally, many of the large charterers looking at how finance could play a role in this, and where it ended up, if you like, was just banks being signatories so that the major capital providers to the industry could align our portfolios with the IMO's trajectory. So it is about emissions. It is not about anything else at this point, but it is a framework to which banks who are signatories can add other issues as they see fit in future, and a logical one will be recycling and scrapping. But it is about emissions targets. It's not about anything else at this point. So the various different technologies are all going to be part of, the broader debate. And what banks are doing here is merely indicating the importance of taking climate change into consideration in their financing decisions. The work originated from the Task Force on Climate Finance Disclosure, led by Bloomberg and Carney, and Citi, DNB, and Soc Gen were the three shipping banks that were amongst the 16 banks that did that initial work and have published their results. That's why the three of us were the leading banks on this drafting committee. That Task Force on Financial Disclosure is now at the front of all banking regulators look at what the financial community is doing to support governments in terms of addressing climate change. So we were, in a way, as a community, ahead of everyone else. And because shipping is outside of the national targets for emissions, we have that transparency, that global transparency that enables us as banks to support the industry making that change. It's only 3 months since we actually launched the principles in a hotel around the corner from here, although it seems a lot longer than that. And the emissions will be for this year, i.e. the emissions for each ship this year. We will then count those early in 2020, and we will assess them against the vessel trajectories in order to come up with a weighted portfolio alignment to the IMO's trajectory. It's nothing more than that, and it's taking transparent information. What is quite surprising is the number of ship owners who don't know about the IMO regulation requiring them to provide that information. It is not about anything else. So there have been comments that banks are introducing more tough climate covenants into their loan agreements. That may be true by individual lenders, but that is not about the Poseidon Principles. The Poseidon Principles are merely about moving how portfolios align to the IMO's trajectories over time. And we use the Equator Principles, which were originated in 2003 around project finance, which just report project finance deals done in a single year. This is about how our portfolios move over time and align to the IMO's trajectory. So what we're doing as lenders is incorporating policies around the impact of climate change on the industry into our lending decisions. And yes, that will have an impact. But what I want to be very clear is that each lender, each signatory, will continue to make their own credit decisions, their own risk decisions, and climate alignment will be one of them. There is clearly no collusion or anything else between banks as to how they implement that alignment. And of course, the individual lending decisions, type of ships, type of technology, all those things will go into making up, if you like, the alignment of an individual bank's portfolio. The other key point is each bank will publish that alignment in their sustainability or citizenship or whatever other report they publish. It will be on the Poseidon Principles Association website. So it's transparent, and in that sense, each shipping bank will be quizzed, no doubt, either by their senior management or, of course, by their shareholders as to why their portfolio is or isn't in alignment. The thing we know is the IMO is going to tighten those trajectories. And so that is the challenge, if you like. The decisions that banks are going to be making from now, that we are making today, will have an influence over that. And that's, if you like, the big change that's taken place.
And so just to clarify, there's no, the borrower or guarantor who's mortgaged their ship for the loan isn't really facing a default if they don't meet trajectories. It's just a reporting requirement. So they shouldn't fear it.
There's nothing to fear. The only covenant we've introduced at the request of the borrowers on the drafting committee was to have a standardized information covenant, so that the way in which we gather the information is in a standard form and borrowers don't have to negotiate 10 different versions with 10 different lenders. If a bank individually chooses to apply that information with additional covenants, that is up to that individual lender. It's not part of the Poseidon principle.
Evan, do you want to add anything? Or I ask Jack and
Well,
Evan?
I don't really want to steal Michael and my thunder. There's a 12 o'clock show up in the
Sure.
library that's
So
going
we
to
don't
be
have to spend
completely
it.
different, action-packed, and so I don't want to steal our thunder. But I think it was quite courageous and proactive that the banks came together and did this. It's really about measurement. We've all tried to lose a few pounds. Easiest way to do it is to step onto the scale and measure from point A to point B. And in many respects, we're trying to understand in a more quantitative method the types of admissions that the industry in totality is generating as measured through the prism of the maritime financiers' vessel portfolios. And this is all to get to a lower carbon future, which I think is important for everyone. And you know, it's interesting on this emissions, DNB Markets recently issued, or was part of a group that issued a green bond for TK Offshore. And the bonds were used to finance the most modern, eco-friendly shuttle tankers in the world. And some of the numbers on these shuttle tankers are startling. They're using LNG-powered technology. They have hybrid battery systems, and it's a 47% reduction in CO2, an 88% reduction in NOx, and almost 100% reduction in SOx. And to Michael's earlier point, we have to reimagine what the ships of the future are going to look like. And these ships, there are 4 of them, but this is a starting point out of the total global fleet that is going to act to lower the emissions and hopefully reduce the impact that the climate change is having on the world.
So they're sort of setting a precedent and a pattern to follow in the future. Evan, what does CIT think of this? If you can speak officially.
I'm supposed to sign.
Oh.
No, we are in a fortunate position. So, of course, we're very supportive of the good work Michael and Evan have been doing. And we're the fortunate position is as we restarted our ship lending business the past year, we're catching the moving train in a way. It is, we're lending to owners that are now, let's be honest, taking economic decisions. So we're helping them finance those scrubbers and other investments. We're financing newer ships at the average portfolio age. So we want to progress that during the course of the year as we start our second year of business in this phase.
Jack, do you see Chinese banks and leasing companies joining this movement?
Yeah, I think, yeah, of course, we think all of the Chinese lessors and the banks are supportive to the Poseidon principles. And I think, yeah, we understand Michael himself have already presented the principal concepts and the details to our president and our senior management team. And first half of this year, we have closed one deal with Citibank. So we have the opportunity to have a close look at the particular covenants clause. So I think this is very good for the ship owners, for the industry, for the society. So you know, for banking industry, we already have the equity principles is quite similar to our Poseidon principles. It's also to propose the very green finance for the society. So China Post Bank always wanted to promote this kind of very environment friendly green finance for the projects. So we shall follow this kind of trend and say we are in discussing very seriously. So actually, some of the Chinese lessors had some discussions in Beijing for this kind of, if how we practice these principles, how we follow the Citibank and the DNB and others, how to practice to how we pass this message to our clients. So we are very serious to consider these principles.
Well, thank you. I think if we're done with that, we'll move on to a real current topic of international trade and sanctions, tariffs and sanctions. As everyone's aware, there's been a trade war going on, and there's, of course, a host of international sanctions that are being placed on shipping that visits Venezuela and Iran and others. And I think I read in an article this morning that, 20% of the VLCCs are considered to be off limits because of sanctions, I guess Costco's fleet. How are these trade sanctions and tariffs affecting shipping banks? How are you adjusting to them? Are you adjusting at all to them? Anybody?
Well, I think it's just it's a nightmare for your compliance people. I mean, if we have borrowers who suddenly are sanctioned, then that creates all sorts of obvious legal requirements on us and on most banks, if you're an American bank, and the sanctions from the US, obviously, in particular. So it doesn't, I'm not sure it dramatically changes any sort of business decisions, because it's impacting really decisions you've already made if those vessels are in your portfolio or the borrowers are your clients. So it's another thing to navigate, and of course it makes life more difficult. The byproduct clearly is an unexpected bonus for the tanker market, and who knows how long that will last, but that is, if you like, an unexpected tightening of supply, if you like, and so in that respect it's probably a good thing for many ship owners, but other than the compliance issue, I'm not sure it has a huge impact on the way banks look at the business.
I think it's very hard to be an active market participant in the maritime community and not have some type of Costco tangential relationship. And the word nightmare is very apt to describe some of the Trump administration's recent forays with slapping sanctions onto these different global active market participants. You do not want to mess around with OFAC. That puts you on a naughty list that can put a branch or a bank really in a state of suspension. You do not want to mess around with OFAC. And when some of these different issues arise, I think it was September 25th or something like that, this was an immediate compliance red alert situation internally. And compliance, as many folks know, has been one of the hottest sectors within the banks, and this was a real situation for our customers to deal with. And again, what you've seen, and we'll stay away from politics here, is the Trump administration really using sanctions as financial weapons against other countries. I mean, I think it was introduced this morning that targeted sanctions have been put out against Turkey. And it's just another example that we now have to do reviews of the portfolio if there's any Turkey exposure as well. So these are very live issues. Again, if we speak to the broader trends here, 10, 15 years ago, you were really worrying about credit risks within the portfolio. Now these risks have multiplied out of just sheer credit to compliance, sanctions, anti-money laundering, a whole plethora of other risks that have been introduced into traditional maritime finance.
And so you're adding, and Evan, I'll let you go in a second, but you're adding that assessment to loan intake, I take it? Are you beefing up, reviewing potential customers for future non-compliance, if you can, or just
I think it's part of a standard? I think it comes down to a holistic assessment of the borrowers and how credible sustainable and thoughtful these borrowers are, but it is more from just a kind of a credit assessment of the borrower to really a much more holistic assessment of the risks.
Yeah. Evan?
Yeah, there's a few points there. So all the banks have to, looking in retrospect, as Michael said, all the banks have business on the books. So have you been keeping track of it? So quickly knowing whether one of your clients is exposed to a sanction is key. So that's the first step. So the good news is I see the banks, starting with my own, knowing that very quickly and knowing it thoroughly. Then it's, how quickly you respond and how the client is impacted. So if you don't have a direct exposure, the client itself may have other exposure, and then you're into the morass of all that reporting requirement. So far I've seen the banks responding quite efficiently to that. You don't always see that from banks, but in this case it works. And then you have to worry about whether how badly your clients are going to be hurt and how that affects their business and their ability to pay you back.
Sure.
Yeah.
It becomes a credit. It becomes a credit risk.
So the KYC issue that's the opening act, but then it's the credit issue, yeah.
Yes, I fully agree with Michael. It's a nightmare for compliance people. So compared to before, even for Chinese leasing company, so we are maybe people know Chinese lessors very efficient for the project finance. But now we have a longer process for KYC for anti-money laundering process. So also maybe some of the Chinese lessors very willing to provide finance to our US or UK listed companies. That's because these companies is much more transparent for their operations. So I think the geopoliticals have created a lot of uncertainty for the industry. So for shipping finance, the compliance always is our bottom line. So we shall comply all of the regulations and kind of keep dialogues with our clients to keep all of the deals to follow all of the real regulations. And also sometimes maybe we are forced to sell some of assets or projects, so it's not complying with sanction clauses. So in the future, I think maybe it's created a lot of more jobs for us.
Yeah, right. I think we're about to run out of time, but I'd like to ask the panel what's their view of bank finance for the shipping industry in the future? To sort of wrap up, what do we think it's going to look like over the next couple of years? We sort of touched on it a little bit in our discussions, but sort of your summary. What's your forecast? Will increased banking capital requirements hurt you? Are we done with those types of capital requirements? Is it plateaued? Where do you think things are going to end up? Evan?
Yeah. I think the shipping lenders who are there will be there. Some will start to come back. Will you see in my career the next wave of Hamburg-based banks putting out billions? I don't think so. But okay. I think you're finding a natural equilibrium between the Asian lenders, the existing lenders, the private equity that's out there, debt funds are rising, combinations of those things. So there's money will be there.
Okay.
Everything will be green. A lot of stuff that says it's green now isn't really green. So it will be, I think the capital markets will play a huge role because the whole reindustrialization of shipping will be led ultimately through the capital markets because of the scale of it, because of the need for both the energy industry and the shipping industry to transition, and the more they transition hand in hand, the more financeable it becomes. And I think the role of banks as feeding that, if you like, as being part of the origination of that, and then I think capital markets will take over. And I think the other key thing, which we haven't touched on yet, is the Greta Thunberg generation who want to know, where it came from, how it was made, and how it was delivered.
Who financed it.
And who financed it. That is going to have a huge impact on this industry, and different sectors of the industry will react differently to that. But I think let's not underestimate the importance of this industry and the opportunity this industry has to emerge from the shadows it likes to hide in and to get recognized for what it actually delivers for the global economy. And if it delivers it in a transparently and environmentally friendly way, that is a huge financial opportunity for the industry that makes it much more bankable. At that point, I think you'll see a lot more investment coming in, whether it's from public equity, private equity, debt capital markets, or whatever. It's probably 5 years out, but that will be the transformation. And banks will continue to have an important role.
Yeah, I think, more and more rules coming, like 2020, like precedent rules, like the new sanction clauses. So that's created a lot of challenges to ship owners, to shipping finance institutions. So, and also there's a new trend for the ship owners. Some of the lessors maybe just directly place liquid orders by themselves and attached by the long-term charter from the commodity traders. So that means maybe the finance come from the commodity traders' facilities. So this is not the traditional shipping finance, not asset-backed finance. So this is the new tendency. We need to look for that. And also the trade tension maybe created different models for the shipping operations. Maybe there's a new trading pattern coming. So there's a different port regulations, different ship designs. So that's why also I learned from this morning's panel discussion. So very few ship owners wanted to place liquid orders because there's a big uncertainty for that. So there's a lot of, I think maybe some of the chaos for that. So we need to see how to find the solution for that. But shipping finance institutions should just take the wheel from long-term ship. So we cannot just judge by one time or one point to say the asset is cannot accept, the asset is popular for that. So I think, in long-term ship wheel, so we always wanted to stay with the industry. They wanted to partnership with the real ship owners to find the solution to obtain sustainable growth for the industry.
Thank you. Evan, you get the last word.
Thank you. In as much as it may disappoint many folks in this room, the era of 8-year, 80% sub-LIBOR plus 100 basis point money is probably concluded for now. And I think the shipping financiers of the future are going to be more nimble, more short-term in their capital deployment, and are going to serve as more of financial intermediaries to provide institutional capital to the maritime industry. The way that borrowers, I think, get there is the borrowers need to generate, I think, cash flow, and free cash flow has been used a number of times, but there's just got to be more cash flow coming out of these companies. There has to be sustainable net income. I think part of that is going to come with a lower quantum of total debt on companies' balance sheets overall. And I think for the equity market investors, you've got to have larger entities, not just $1 billion, but $2 billion market capitalization entities that have much better share liquidity for folks to trade in and out of to create a more sustainable public market for the companies to serve in. But make no mistake, I think the banks of the future will take more of a financial intermediary type of role.
Interesting. Thank you. Do we have time for, we're done? Okay, thank you. I want to thank our excellent panel today.